Picture this, it's finally Friday, and after grinding through 40-hour-long work weeks at your job, your boss hands you your paycheck. You are excited and you head out for the weekend with a sigh of relief. Before you come home and rest after a long day at work, you quickly swing by the ATM to deposit your hard-earned check. Your Friday couldn't get any better. But then suddenly you realize that the house rent is due on Monday and your check that you just deposited will take 3 to 5 business days to hit your account, which means you won't be able to make the payment on time. Oh no, you are devastated. Suddenly, all the joy from getting your paycheck evaporates. You're in full panic mode, but out of nowhere emerges the one and only Jerome Powell and gently places his hand on your shoulder, and as he looks you in the eyes, he calmly reassures you that everything will be just fine. It won't always be like this. He says, "Welcome to the world of instant payments, where you can deposit your check in real time and get access to funds without having to wait." And sure enough, he was telling you the truth. Introducing FedNow. You probably have been hearing about FedNow all over social media and on the news lately and wonder, what does it have to do with payment services? Because based on the name FedNow, it sounds like it has something to do with the government, and why would anyone be excited about that? Well, it has everything to do with the Federal Reserve, and as you've been told, Federal Reserve has nothing to do with the government and is not a government entity, so there's no need to fear. They are just an independent group of bankers who have your best interest in mind, and among all the services they provide to help you thrive during any economic conditions, the latest service they introduced is called FedNow, and that is what we're going to talk about in today's video. Before we continue, please take a moment to like and subscribe. Let's dive right in. The Federal Reserve has been working on this new invention since 2019, and on July 20th of this year, a few days ago, it finally went live. To be clear, it's not necessarily a new invention. In fact, the same service has existed in the United States since 2017, the real-time payment network, and is used by more than 300 banks. Even countries like United Kingdom, Brazil, and India have had similar services for years. Before I get into what FedNow is and how it works, it's important to understand that FedNow is not a central bank digital currency. We will talk about that later. The purpose of this service, at least for now, is to simply help your bank transfer money in real time 24/7, 365 during any day of the week, similar to what private companies like Venmo and Cash App are offering, although there are some key differences. For example, unlike Venmo, FedNow is not going to be an app that you can download from the App Store, but it's rather a network where participating banks can connect and transfer money within minutes, and you, as a member of that participating bank, can benefit from it. So far, 35 banks have signed up as early adopters of FedNow, including JP Chase and Wells Fargo. At this time, banks are not required to join the FedNow network, and it's all voluntary. Treasury's Bureau of Fiscal Service is also one of the early adopters of FedNow. This is the department that is responsible for issuing payments like tax refunds and Social Security benefits to people on behalf of the federal government. Here's another important distinction to keep in mind when comparing FedNow to apps like PayPal. Instant payment settlements can work in either closed-loop or open-loop systems. In closed-loop systems, transactions are handled by a single provider, so both the sender and receiver must have an account with that particular provider. Great example of closed-loop systems are apps like Venmo, Cash App, and PayPal. On the other hand, in open-loop systems, transactions can take place between accounts at different banks, and participants are not required to have accounts with specific apps for financial institutions. Open-loop payments are processed through a shared network, which would be FedNow in this case, which directs and settles payments for enrolled banks. Cost and transfer limits are also among the differences between FedNow and these private apps like Venmo. Since FedNow is run by the government, it's obligated to operate without profit and only break even. This could potentially lead to more competitive pricing, making it more appealing for banks to adopt and use the payment system at a faster pace. At the beginning of 2022, the Fed did announce that it will charge participating banks a $25 monthly participation fee, a 45-cent fee per credit transfer that the sender will pay including returns, and a 1-cent fee for a request for payment message that the requester will have to pay. Keep in mind that these are fees that banks will have to pay, but I have no doubts that banks will pass these fees onto their members. Currently, the default credit transfer limit is $100,000, but banks can lower or raise their credit transfer limit to $500,000. Now, let's take a look at the fees for Cash App and Venmo and see how those are different compared to FedNow. You might say, isn't Venmo a free app? Are there any fees associated with using Venmo? The answer depends on how you use the service. Venmo doesn't charge a fee for creating an account, maintaining one, or transferring funds to others when using balance or bank accounts, but Venmo does charge fees for certain activities. Instant transfer is one of those activities when a Venmo charges you a fee to transfer funds instantly from your Venmo account amount to your checking or savings account. You also have an option for standard transfer, which are sent through ACH networks, and those don't incur a fee. Instant transfers, on the other hand, are processed through a payment card networks and are more expensive, and the fee is 1.75% of the transfer value with a minimum fee of 25 cents and maximum fee of $25. Credit card processing fees are another one. You won't be charged a fee if you send money to others using Venmo balance or funds from your bank account or debit card, but if you send a payment funded by your credit cards, you'll have to pay a fee of 3% of the total transaction. Venmo also has a merchant fees which apply if you're using Venmo for business or charity. These are transaction fees that sellers pay each time they receive money for goods or services. Even as a personal user, you may have to pay these fees if someone identifies a payment to you as related to goods and services. The seller transaction fees are 1.9% of the transaction plus 10 cents. On top of all these fees, Venmo has a weekly $20,000 transfer limit for verified users with a $5,000 limit per transfer. Cash App has very similar concept. While downloading the app, creating an account, or sending money are free, the platform does charge a fee for instant transfer anywhere from 0.5% to 1.75%. Cash App's daily transfer limit is $5,000 with a monthly limit of $15,000 if you have a cash card. So as you can see, FedNow appears to be much more cost effective compared to Cash App and Venmo, making you wonder if it will replace all these apps. Many are saying since FedNow is not a consumer-facing app, it's not going to compete directly with peer-to-peer apps like Venmo, but let's be honest, if a consumer has the option to transfer money in real time with low fees directly from their bank app instead of downloading and setting up a separate app, they will go for it. Think about it even from the security perspective. If you have to use your bank credentials for a transaction rather than a third-party app, the risk of getting your data compromised is much lower. Here's another thing many people have been wondering about. Is FedNow a framework in place for central bank digital currency? At the beginning of the video, I mentioned that FedNow is not a CBDC, it's just a payment gateway, but could it be that its service will eventually replace cash with digital currency? Well, according to the Federal Reserve, the answer is no. They're saying the FedNow service is not related to a digital currency. In that same article, they say the Federal Reserve has made no decision on issuing a central bank digital currency and would only proceed with the issuance of CBDC with an authorization law. In other words, they can only issue a CBDC with congressional approval. Although, during a recent hearing of the House Committee on Monetary Policy, Jerome Powell suggested that introducing a wholesale central bank digital currency might eliminate the need for congressional authorization. And here's the difference. Unlike the retail CBDC, which would be available to the general public, a wholesale CBDC would only be available to banks and other financial institutions. During that same House committee hearing, Powell said the United States is still years away from introducing a digital currency. No one knows when it will happen. The bottom line is, we know for a fact that the Federal Reserve is working on creating and testing a central bank digital currency along with 130 other countries. That's not a conspiracy theory. The question is, what does CBDC have to do with FedNow and how are they relevant to each other? As you may know, one of the primary objectives of CBDC is to increase the speed and efficiency of payments, and that's exactly what FedNow is aiming to do, leading some to believe that FedNow is a stepping stone towards the launch of CBDC. Meanwhile, others argue the opposite, saying, and now that we have the convenience of instant transaction settlements through FedNow, we might actually not need CBDC after all. It looks like the public is divided on this topic. The question that I have is why the government would step all over the private sector to build something that already exists. As I mentioned, the real-time payment network already does what FedNow promises to accomplish. It's the same technology, why not build off of it? It looks like the only difference is that the private sector owns the real-time payment networks while FedNow is owned by the government. You see, when you're dealing with the private sector, things are simple. If you don't like their service, you can simply stop paying for it. And if they're really that bad, they'll lose their customers and eventually disappear. But when you use government-owned service, you don't have that luxury and your options are limited. Here's another thing I'd like to mention that you may recall. Even though the Fed has been working on the FedNow project since 2019, they increased the pace of its development during the banking crisis earlier this year that began with Silicon Valley Bank. Many believe that the fact that people were not able to withdraw their money instantly fueled the panic even more and caused more bank runs. With the FedNow service, there is a chance this problem can be solved in the future. No more panicking about your money not being instantly accessible. But here's the thing. For you to get instant access to your bank account funds, the money needs to be available in the first place, so you better hope your bank is solvent. And as we've seen recently, banks can go bankrupt and your money is not always safe, so FedNow is not fixing the issue with bank runs. But this is where CBDC comes in. The idea of digital money is not new at all. Nowadays, many of us rarely carry cash and prefer to pay for things with simple swipe of a credit card or debit card. In fact, over 97% of the money in circulation today comes from checking deposits. These are dollars that we deposit online and they get converted converted into a string of digital code by commercial bank. You might be wondering what sets apart CBDC from a regular credit cards or app-based payments that are already digital. Well, here's the thing. Currently, the only way for consumers to use money that is directly backed by a central bank is through a physical cash. The digital retail payment tools we have today use the same currency unit, like the dollar, but they rely on money that is backed up by commercial banks, not central banks. You see, money provided by a central bank, just like cash, is considered a risk-free asset. Let's take the example of a dollar bill issued by the US Federal Reserve. It's always worth $1. On the other hand, a dollar in commercial bank account, although theoretically convertible into paper cash upon request, is subject to the solvency and liquidity risks of that bank. This means that consumers might not always be able to access their money and could even lose it if the bank goes bankrupt. CBDCs, just like banknotes and coins, would be direct liability of the central bank, carrying its guarantee. To put it simply, imagine every citizen having a checking account with the central bank. Worries about bank runs or deposit insurances would become a thing of the past. But make no mistake, given the invasive nature of CBDC, privacy and security concerns will be even a bigger worry than bank runs. That's all I got for you today. If you made it to the end, thank you for your time. I'll see you on the next one. Stay safe and stay informed.